So I'm Andrew with Jesani Wealth Management, and I want to discuss private credit as its own asset class, which has certainly seen exponential growth, especially since the 2007-2008 financial crisis. And it's really become a favorite for investors to add to their portfolios to have another non-market correlated asset to provide for diversification. So non-correlated meaning not contingent upon the stock market performing well. And of course, it's also separate from real estate. So the real estate market doesn't need to do well for the private credit markets to continue to generate a return. But it's had significant growth in the last 10 years. And I'll discuss the reasons why that's happened. But recently at the Greenwich Economic Forum, they had a panel specifically on private credit. And one of the most well-known private credit financiers is Kip DeVere, who was the founder of Ares Capital Management. And he said at this point, private credit is no longer the niche alternative investment asset class that it once was. And it's really grown into its own sector of the U.S. economy, which would kind of put it in line with the other three major investment components, which are fixed income and debt markets, which are about $53 trillion, equities, which is $49 trillion, and then, of course, real estate at about $21 trillion. Now, it's estimated that total private credit outstanding right now is about $2 trillion, which, again, is a much larger number than it was, about 10 times greater than it was in 2005, 2006. And the reason that that's happened is prior to the '08 financial crisis, if a company needed to borrow $150 million to go out and make an acquisition, they could go to the big banks, so Bank of America or Wells Fargo. However, there was a lot of regulation passed after 2008 and 2009, which really tightened up the lending restrictions on the larger banks, and they're just not providing the capital like they used to, which really kind of paved the way for private credit funds to come in and fill that void. Now, just to kind of make you understand how much that market has shifted, so in 2005, of the total private credit market, the big banks were accounting for about 25% of that, and private credit funds like the one I'm talking about today were about 12%. And that dynamic has completely shifted. Now private credits are over 25%, and the big banks are less than 12%. So why has this market grown so significantly? Well, there's a few major reasons, probably the first being what I was just talking about, that the big banks just aren't lending, so it really opened the market up for private credit. But there's other reasons also. One of them may be that it's really the consensus in the overall market and from most investors that the key drivers that have pushed the market higher and generated yield and growth over the last 10 years likely are not going to be the key drivers that continue to generate yield going into the next decade. So it's opened the way for not just private credit, but other alternative investment classes as well. In addition to those two reasons, also the alternative that a company has if they need to go out and borrow 100, 150, 200, $300 million is to issue bonds, which is certainly a cumbersome process, takes a long period of time, up to 18 months, very highly regulated as they have to register those securities with the SEC. And there's a lot of expenses built into that for the company that's doing the bond issue. And the fourth one has to do with private equity. So another growing alternative asset class is private equity, which is a whole nother kind of video, a whole nother conversation, but leverage buyouts in particular. So private equity funds typically keep dry powder or cash on hand so that when they see a target and identify a target that they want to acquire, they have the capital available to do that. Now, back in 2005, on average, private equity companies had $145 billion in total of dry powder. Now that number is 530 billion, and they're using that capital to as collateral to go out and borrow funds from private credit and then make their acquisitions. So that is really the private equity asset class has really also driven the private credit asset class. So what exactly is private credit? Well, it's simply any loan done away from the public markets by an entity other than one of the major banks, like Bank of America or Wells Fargo. But I want to discuss some of the kind of structure and the inner workings of a private credit fund too, and just some of the important key metrics that an investor would want to look at and one is loan to value, which is similar to like debt to income. If you're purchasing a house, if a company wants to borrow 100 million, let's say they're borrowing that on 50% loan to value, well, the private credit fund would, through the underwriting process, would make sure that they had at least $200 million in equity available in that company or cash or wherever to secure that loan. And that kind of leads into the second. You have senior secured, which is also known as first lien. You also have second lien private credit. There's also distressed private credit, which is you could kind of compare to like the subprime loans of the early 2000s. And usually the term on the loans is very short when compared to other lending vehicles. I think the average is about 4 years. So 3, 4, 5, 6-year loans. Senior secured, you want to look for first lien. Of course, you want to look at a private credit fund with the intent of having a zero default ratio, which of course is impossible, but the more T's you can cross and I's that you can dot to make sure that you're reducing your risk exposure is very important. And I would say that any alternative investment, and this isn't just my opinion, it's just the smart thing to do. There's many different types of funds and different shapes and sizes available in each particular sector. You're going to see ones with higher yields, ones with lower yields, more growth potential, less growth potential. And what I've certainly learned in my 15 years in my career is that it is worth it to focus on quality and not quantity. Because of course, if you can avoid a deal blowing up or losing 30, 40, 50, or 100%, those are the types of things that really can have a dramatic negative effect on your long-term returns. So stick with the best. Might want to stick with first lien, loan to value at 50% or better. And also private credit is not interest rate sensitive, at least most funds aren't. So it may make sense to look for a fund that is tied to either SOFR or LIBOR. So LIBOR is the London interbank rate for overnight lending, which on average, the credit funds that we look at will do their loans at about LIBOR plus 6. So that takes away the interest rate sensitivity and also the duration sensitivity from public treasuries. Now, actually, LIBOR at the end of 2021 was going through some issues, so they replaced that with SOFR, which is the secured overnight funding rate. So going forward, you'll probably see funds using the SOFR rate plus a typical percentage plus fees. And in general, you should see a yield anywhere between 7, 9, maybe as high as 10% through private credit funds. So the largest sectors that most of the funds are lending to are, of course, technology, software, professional services, IT, healthcare, infrastructure, and insurance companies. Now, I mentioned that we look for senior secured loans, and you should too, and also first lien positions. And some of the other ways that you can look at a fund is the covenants that they use, which a covenant is really, let's say a private equity fund private credit fund is underwriting a deal. Well, in addition to them being able to go after that company if they default in order to get their layout of principal back, they can also go after additional capital. So it provides actually the private credit fund with leverage against the borrowing company. There's also lending restrictions that you can look for, meaning, of course, if a private credit fund extends a $100 million loan, and then that company goes out after that and borrows another $50 million from XYZ fund and another $40 million from Bank of America, it's going to decrease the position that the initial private credit loan had. So there's restrictions that they can put on the borrowing company to try to reduce the default risk, which is another kind of component that you want to look for and see what type of covenants and restrictions they're using. So now to kind of talk about the pros and cons, of which there's many. The first item to kind of differentiate between the two is there's secured lending, publicly traded secured lending funds, which are different than private credit. A lot of parts of it are the same. However, similar to like a publicly traded REIT, a publicly traded secured lending fund, the loans are the same, the terms are the same. It's all the same processes, except that it's publicly traded. Now, that can open up a scenario where that position is going to go up and down or gain or lose value based on overall market sentiment, which I think for some investors could certainly be seen as a con, because in a way you're defeating the purpose of trying to correlate away from the public equity markets. So be aware that there's a difference between private credit and secured lending or traded credit funds. So the volatility in a public fund is probably the biggest detractor. But of course, on the flip side, that can also be a benefit for some investors because you can generate that 8, 9, 10% yield and have complete liquidity anytime that you want and sell it like a stock. And of course, on a fund like that, there's no minimum investments. If you want to buy $1,000 in shares, you can buy $1,000 in shares, which when you get to the private credit, it's the opposite. You'll typically see higher barriers to entry, higher minimum investment requirements. Most funds, at least the higher quality funds, are going to be limited to accredited investors with $1 million net worth or $200,000 per year annual income. And they're very liquid. There typically will be a holding period on a private credit fund of 1, 2, sometimes 3 years, and a penalty if you do decide that you want to get out, take your investment out before that period expires. And private credit in general can have more consistency, of course, than a publicly traded fund. And I think that's one of the main pros and what attracts investors to private credit is that you get a consistent income or a consistent dividend of 7, 8, 9%, depending on the particular fund. But the downside to that is you really have limited growth. So if you compare it to like a private REIT where you get your income and also have potential for a capital gain, there's not really a potential for a capital gain in a private credit fund. You really get the interest from the loans or your rent, and that's it. You're not going to see capital gains. So it's strictly income, which also could be a bit of a detractor for some investors because it's going to be taxed as ordinary income, of course. So if you're in a high tax bracket, you want to be careful about how much you're investing into a private credit fund and how much income you're generating, because you could end up being taxed at very high levels. So those are kind of just the basics on private credit. If you ever want to know more about some of the funds that we're using for our clients right now, certainly reach out to me. My name's Andrew Constantinidis with Jesani Wealth Management, and I can be reached at 954-800-8552. Okay, thanks everyone. Take care.